All right, welcome to this deep dive. Today we're tackling a pretty detailed document on INDAS116.
Ah, yes. Property, plant, and equipment, PPE.
Exactly. The big physical stuff companies own and use for, well, for a while.
Things like buildings, machinery, vehicles.
Right. And this document, it really lays out the whole life cycle, doesn't it? From, figuring out the initial value to depreciation, right down to the written down value.
It does. It's like tracing the asset story on the company's books.
So our mission today is really to pull out the essential steps, maybe some key insights from this document, make it clear how this all works.
Sounds good. Where should we start? The very beginning.
Yeah, let's. First hurdle. Does an item even qualify as PPE under INDAS116?
Good starting point.
Yeah.
It sounds basic, but it's crucial.
Yeah.
Is it tangible? Can you touch it?
Okay.
Is it held for the company to use in production or supply or for admin or renting out? Basically, not primarily for resale.
Right, so not inventory.
Exactly.
Yeah.
And is it expected to be used for more than one accounting period? Usually a year.
So tangible, used by the company, and long-term.
That's the gist. If it ticks those boxes, it's likely PPE. If not, it might be inventory or maybe an intangible asset governed by different standards.
Okay, makes sense. So let's say it is PPE. How do we figure out its initial value, that first number that goes on the balance sheet? That seems vital.
Or absolutely vital.
Yeah.
And the document is clear. It's more than just the invoice price.
Right.
You start with the purchase price, sure, but then you add all the costs directly attributable to bringing that asset to the location and condition necessary for it to be capable of operating in the manner intended by management.
Okay, like what kind of costs are we talking about?
Well, things like import duties, any non-refundable purchase taxes, cost of site preparation, initial delivery and handling, installation and assembly costs, even fees for architects or engineers.
So really getting it ready to run.
Precisely.
Yeah.
And here's an interesting one the document highlights. The initial estimate of costs for dismantling and removing the item and restoring the site later on.
So if you have to clean up afterwards.
Yes, if there's a legal or even a constructive obligation right from the start because you installed the asset, that future cost gets factored in up front, discounted to its present value, of course.
Wow, okay. That's comprehensive. What about things you don't include?
Good question. You definitely deduct trade discounts and rebates.
Naturally.
And you exclude costs that aren't directly necessary, like general admin overheads usually don't get added, or costs incurred after the asset is ready but before it's actually used, unless they are essential enhancement.
And if a company builds the asset itself?
Similar principle. You capitalize direct costs, materials, labor, and potentially certain borrowing costs if the asset takes a substantial time to get ready under INDAS116.
Got it. So that's the initial cost sorted. What's next before you even start using it day to day?
Right. Before depreciation kicks in, you need to estimate two key things. Its useful life and its residual value.
Useful life, how long you expect to use it for?
Exactly. How long the company expects to derive economic benefits from it, not necessarily its total physical life.
And residual value. That sounds like scrap value.
Pretty much, yeah. It's the estimated amount the company would currently obtain from disposing of the asset after deducting disposal costs if the asset were already of the age and condition expected at the end of its useful life.
Okay. So what you think it'll be worth when you're done with it?
Correct. And estimating these involves judgment, considering expected usage, wear and tear, obsolescence, legal limits.
And these aren't set in stone, right?
Definitely not. This is critical. The document stresses that useful life, residual value, and also the depreciation method must be reviewed at least at each financial year end.
Okay.
If expectations change, you adjust the estimates. But it's a prospective change. It affects depreciation going forward. You don't restate past figures for estimate changes.
Right. So depreciation, that's the big one. When does that actually start?
It starts when the asset is available for use.
Available for use, not necessarily in use.
Correct. That means it's in the location and condition necessary for it to be capable of operating as management intended. Even if it sits idle for a bit, depreciation usually begins.
Interesting. And the amount you depreciate each year is based on...
It's based on the depreciable amount, which is the initial cost or other amount substituted for cost, like a revalued amount minus its residual value.
Cost minus residual value. Got it.
Although, quick point, if, maybe unusually, the residual value is estimated to be equal to or greater than the asset's current carrying amount, depreciation actually ceases to that period.
Because you're not expecting to lose any more value through use.
Essentially, yes. You don't expect further economic consumption beyond what you'll recover.
And how do you spread that depreciable amount over the useful life? The method?
You choose a method that reflects the pattern in which you expect the asset's future economic benefits to be consumed.
So like straight line?
Straight line is common, yeah. Spreads the cost evenly.
Huh.
Or you might use a diminishing balance method, which charges more depreciation earlier on, or maybe a units of production method, if usage varies significantly year to year based on output. The key is consistency, unless the pattern of consumption changes.
Okay. So the asset's value is ticking down with depreciation. Does it always just follow that path? Cost minus accumulated depreciation?
Well, that's one option. Companies have a choice of accounting policy applied to an entire class of TPE. They can use the cost model.
Which is what we just described. Cost less accumulated depreciation and any impairment.
Exactly. Straightforward. Or they can choose the revaluation model.
Revaluation, so updating the value.
Yes. Under this model, an entire class of assets is revalued periodically, often enough that the carrying amount doesn't differ materially from its fair value, what it's worth in the market.
And if the value goes up?
Increases generally go to equity through other comprehensive income into something called a revaluation surplus.
Okay, not straight to profit.
Not usually. Decreases, however, usually hit the profit and loss statement first. Unless the decrease reverses a previous surplus for that same asset, then it reduces the surplus first.
Complex. And then you depreciate the new revalued amount.
Correct. Over its remaining useful life.
What if something bad happens, damage, or the market for that kind of asset just collapses? Does that get handled differently?
Yes, that brings in impairment, which is covered by another standard, INDAS 36.
Okay.
The document mentions indicators physical damage, significant adverse changes in the market or technology.
Yeah.
You test the asset for impairment.
How?
You compare its current carrying amount on the books to its recoverable amount. That's the higher of its fair value, less cost to sell, and its value in use, basically, what you expect to earn from using it going forward.
And if the carrying amount is higher than what you can recover,
Then you recognize an impairment loss, reducing the asset's carrying amount down to that recoverable amount.
does that loss hit profits?
Generally, yes, it goes to the P&L.
Okay.
Unless, again, you're using the revaluation model, in which case the loss first reduces any existing revaluation surplus for that specific asset before hitting P&L.
Right, the equity buffer.
Exactly. And then future depreciation is based on this new, lower carrying amount.
Okay. We mentioned earlier about reviewing estimates like useful life. What if you realize, say, year 3, that the machine will last 5 more years, not the 2 you originally thought?
That's treated as a change in an accounting estimate. You don't go back and fix prior years.
Respectively again.
Yes. You just recalculate the depreciation charge for the current and future periods based on the revised remaining useful life and the asset's current carrying amount.
Okay. And finally, the end of the line. Selling it or scrapping it.
That's derecognition. When the asset is disposed of, or when no future economic benefits are expected from its use or disposal, you remove it from the balance sheet.
And any profit or loss on that?
The difference between the net disposal proceeds, if any, and the carrying amount of the asset at that time is recognized as a gain or loss in the profit and loss statement. Straightforward.
So pulling it all together, that term written down value, or WDV, where does that fit?
The WDV is essentially just the asset's net book value, or carrying amount, at any given point. Under the cost model, it's typically that initial cost, less all the depreciation charged to date, and less any impairment losses recognized.
Simple enough.
If you're using the revaluation model, it's the latest revalued amount, less any subsequent accumulated depreciation and subsequent accumulated impairment losses. It's the bottom line figure for that asset on the balance sheet after everything.
Right. So we've really followed an asset from cradle to grave on the books. Initial recognition and cost, its life being measured and depreciated, possibly revalued or impaired, and then finally derecognized.
That's the journey under INDAS116. Understanding that flow is pretty fundamental to grasping how companies account for these major long-term resources.
It's not just ticking boxes. It reflects the economic reality, or the attempt to reflect it, of using up these physical assets over time.
Absolutely. The consumption of value and changes in worth.
Yeah. Thinking about this whole process, what does it make you wonder about next in terms of how companies report their financial health? Perhaps how these tangible assets interact with the intangible ones?